Good morning and welcome everyone. Please sit back and relax while we wait for the rest of our participants to come on live. Some housekeeping announcement. If you have any questions with regards to the topics, please scan the Slido QR code at the screen, or you can use the Q&A feature at the top of MS Teams screen. Feel free to type your questions for our speakers to answer during the live Q&A session. For your kind information, at the end of the session, there will be a survey link in the chat box, and we would appreciate if you could spend a few minutes to complete the survey. Good morning and thank you for joining us today at our Moving into the Endemic Phase Transforming Challenges into Opportunities webinar. We would like to take this opportunity to apologize for the postponement of the earlier webinar scheduled on Friday, 25th February 2022, as the whole workforce at Menara AmBank had to be evacuated immediately due to the tremors felt in our building and also a few other areas in Klang Valley. We are truly honored to be able to gather today with distinguished speakers from PricewaterhouseCoopers, Malaysia. Thank you to all our guests for making time to join us today on this sharing session. To kickstart today's session, we will now invite our speakers from PricewaterhouseCoopers, Malaysia. Allow me to introduce our distinguished speakers for today. Ms. Jennifer is a partner who heads the financial services team of PricewaterhouseCoopers Taxation Services Sendirian Berhad. She also functions as the Islamic Finance Tax Leader for PwC in Asia and PwC's Academy Leader. Jennifer has extensive tax experience of 31 years both in Malaysia and Australia. In Malaysia, her experience includes advising clients on tax matters relating to income tax, real property gains tax, stamp duty, service tax, Islamic financing transactions, and applicable tax incentives. Our second speaker, Mr. Stephen Liu, is a senior manager in PwC and is focused in corporate tax compliance and advisory working experience. He is currently servicing a wide range of large multinational and local corporations in various industries, covering manufacturing, services, property, banking, insurance, takaful, asset management, stockbroking, leasing, healthcare, as well as Labuan companies. Please welcome Ms. Jennifer Chang and Mr. Stephen Liu. Over to you, Ms. Jennifer.
Hi, good morning, everyone. I'm Jennifer from PwC, and I've got with me Stephen Liu. And this morning, we will both be presenting to you the webinar, Moving into the Endemic Phase, Transforming Challenges into Opportunities. Let's quickly look into the agenda for today. I will give a very quick introduction before getting into the Budget 2022 updates and COVID-19 opportunities. And then we will both be talking about key tax considerations and planning for businesses before we get into the questions and answer session. So let's just get into the first introduction. When we actually look at what's happening around the world, as all of us will know, there are various challenges experienced by businesses due to COVID-19, decline in sales, disruption in production, liquidity constraints, slow collection, for example, inability to meet payment obligations, and as all of us are aware, adoption of a new normal practice such as working from home. So with all of this happening around us, what are some of the broad fiscal strategies that the government has put in place? It's really some incentives to create and retain jobs in targeted sectors, digital upskilling and adoption, some incentives there as well, encouraging capital spending, ESG measures, as well as some fiscal incentives. Now, when we look at some of the budget announcement, I will start off by going through some of the major items that were announced and that have been implemented. And these relates to corporates. There are also capital market and property sector initiatives, incentives to support small and medium enterprises, SMEs. Other tax incentives have been announced as well, which Stephen will share. Some indirect tax special measures, as well as last but not least, some extension of rebates for personal taxes. So I will cover the first two, and starting with corporates. Now, I think one of the major things that have been announced for corporates, if we turn to the next slide, is in respect of foreign source income exemption. As you are aware, for many years, nearly 20 years, we have a foreign source income exemption where interest income, dividends, royalties, and maybe even rental from foreign properties, if they are brought back to Malaysia, have been exempted. Now, of course, the exemption does not apply to the four types of industries on the right, which is the banking sector, insurance, shipping, and air transportation. These type of entities are actually taxed on a worldwide basis. But other than these four industries, for about 20 years now, most individuals like you and I, as well as companies, actually do not get taxed when the foreign source income have been brought to Malaysia. Next page. So let's just look at what's happening out there as well in other countries. We are not the only country that has used to, exempt foreign income. When we look around the region, you will see that a lot of other countries have actually exempted foreign source income, especially dividend income. So Hong Kong is a very good example. Foreign dividends are not taxable at all. And very similar to us, they are taxed on a territorial basis. So foreign source income is not taxed in Hong Kong. With Thailand, Japan, Philippines, and Singapore, you will find that they also exempt foreign dividends. But of course, there are conditions, such as in Thailand, there is a requirement for you to hold at least a minimum of 25% of the foreign shares, for example, or at least 6 months. In the case of Japan, same thing as well. They actually provide 95% exemption on foreign dividends, and is actually subject to a minimum 25% shareholding of a continuous period of 6 months or more. So you'll find that around the region there's some level of foreign source exemption, but of course there are some countries that have provided conditions for you to meet before that foreign source exemption. Now, turning back to Malaysia, what has happened in Malaysia? From 1st of January 2022 onwards, all foreign source income for residents will be taxable. There was a lot of comments, I guess, made to the government about this, sort of like feedback, because this will impact upon a lot of people. It'll impact upon a lot of companies as well. So as a result of which, yes, the foreign source income exemption no longer applies for residents, for Malaysian residents from 1st of January onwards. But at the end of last year, the MOF actually made an announcement. They've actually said that for the next 5 years, they will give a concession, in a sense that if you're actually receiving dividends and you're a company, for example, for these next 5 years, from January this year until 31st of December 2026, your dividend income will continue to be exempted during these 5 years. For individuals like yourself and me, all classes of income received by us will also be exempted during these 5 years. What we are waiting for right now are guidelines, because they did announce this exemption, but it is subjected to some form of conditions and guidelines. So we'll have to wait and see what the conditions and guidelines are, because if they were to come up with guidelines to say that, for example, in other countries, you have to hold at least 25% of the shares overseas, and if you don't hold 25% of the shares in the company, you may not be exempted after all. So this is something that we'll need to wait and see. It's a little bit of good news, but I think the good news will be subjected to some sort of conditions. We turn to the next page. There is also another concession that if you are taxable and you do bring back your foreign source income during a 6-month period, which is from January this year until June this year, the tax rate that will be levied on your foreign source income will be 3%. And this 3% is based on your gross foreign source income. So no tax deduction will be applicable. From 1st of July 2022 onwards, of course, your foreign source income will be taxed at the prevailing tax rate. For example, if you're a company, the prevailing tax rate is 24%. Of course, if you are taxable, it will also mean that you can claim double tax relief depending on which country you're receiving the foreign source income. Now, this special program of 3%, you may ask, are there any other conditions? What do you have to do? So on the next page, it's just a summary of some of the salient features of this. So I'll just leave this slide for a little quick while. As I've mentioned just now, it is for 6 months only. The tax rate is 3% on the gross income. It does not apply to income derived from Malaysia. Obviously, it's only for foreign source income. You need to make a declaration to join this special scheme. What they have said is that whatever income you've remitted will not be subjected to tax audit or investigation. So if this is a special program that you want to join, obviously you will need to basically make a declaration. Next page. So other than the foreign source income exemption issue that was announced, the other major announcement was Cukai Makmur. Now, Cukai Makmur is a special tax, and it is basically for 1 year only, which is this year, Year of Assessment 2022. And it basically seeks to tax companies that are having a very high chargeable income. Anything that is more than 100 million will be taxed at a higher rate of 33%. So it does not apply to small and medium enterprises, obviously. So if you're an SME, this does not apply to you. It only applies to companies that are other than SME and companies that actually make income in excess of 100 million. And what was announced also is that if you do receive the foreign source income during this year, that foreign source income will be excluded from the computation of tax for the purposes of Cukai Makmur. Next page. One other announcement they made, which is a little bit of good news, is on unabsorbed business losses. As most of you may be aware, Malaysia has got a time limit for when you can carry forward your unabsorbed losses. But if you look around the region as well, it's nothing new, because most countries around the region also has got a limitation on the ability to carry forward and absorb business losses. For example, countries like Indonesia, Thailand, and Vietnam is only 5 years. India is 8 years, Japan is 10 years, and Korea is 15 years. So what Malaysia has done recently is to actually announce that they will now allow a 10-year limit to carry forward the unabsorbed tax losses. So that's a little bit of good news there. One other announcement is in respect of retail money market funds. I'm not sure whether your company has invested in any retail money market funds. We do have some clients that have done that. And what happens is retail money market funds, being a unit trust, will be exempted on a lot of the income that they receive. So when they distribute distributions to the unit holders will actually be receiving tax-exempt income. Now, effective from 1st of January 2022, this will now change, because the intention for a retail money market fund is really to encourage people like you and me, individuals, to continue to save. So people like you and me, no change. We will continue to be exempted if we invested in retail money market funds. But if you're a company and you have invested in retail money market funds, there will now be a 24% withholding tax when the fund manager actually makes distributions to you. Of course, if you're a non-resident, this 24% is a final tax. You don't need to do anything else. But if you are a resident company, for example, this withholding tax of 24% is not a final tax. When you file your tax return, you will have to declare this distribution in your tax return, but you can get a credit for the 24% withholding tax that the fund manager has deducted and set it off against your own income tax payable on this income. Next page. Another withholding tax that has been announced is in respect of payments made to agents, dealers, or distributors. Now, in the past, taxpayers need not have to do any type of withholding tax. They basically just have to fill in a form and declare who are the people that they're making such payments to. Now, over the years, I guess what has happened is probably the tax filing of these individual agents, dealers, and distributors may not have been as high as expected. So what the tax authorities have done is to actually come up with a new withholding tax under Section 107D. So it's a new section drafted that says that you have to deduct a 2% withholding tax on the gross amount that you've made payments to these people. Again, it's not a final tax. Whatever withholding tax that has been deducted can be used by the agents, dealers, or distributors against their own tax payable on such income. And because this is effective from 1st of January 2022, it's very important that if you are making payments to such people, you will have to deduct the 2% withholding tax. Otherwise, the penalty is on you as the payer, and the penalty is at 10%. And the deduction of such payments will also be disallowed. Right, so it's important to note that this includes monetary and non-monetary payments. Now, what has happened, of course, is that because this new withholding tax is effective 1st of January, there's actually normally forms that you need to fill out in order to make the payment. Unfortunately, a lot of these was not ready. So the tax authorities made a media release earlier this year to actually say that they have agreed to defer the remittance of this withholding tax to 1st of April 2022. And of course, there will not be any penalties, but of course, you will still need to make the payment. It's just that the timeline has moved to 1st of April 2022. Okay. Now, we want to cover a little bit of capital markets and property sector. When we look at the capital markets, I think the very good news here is that Malaysia does not have capital gains tax and did not introduce capital gains tax. There was a lot of talk about the government thinking about capital gains tax for the past 2 years. But the good news, of course, is that they did not announce it. It would have been a bit unpopular if they did, obviously. It could have even impacted upon our capital markets. But if you look around the region, apart from Hong Kong and Singapore and ourselves, you will find that quite a lot of countries around the region actually do have capital gains tax. China, Philippines, Thailand, Vietnam, Indonesia. Now, of course, without the introduction of capital gains tax, then what did the government announce? The government has basically decided to increase stamp duty on contract notes from your brokers if you do Bursa Malaysia transactions, for example. And the stamp duty of 0.1% has been increased to 0.15%. there used to be a cap of 200 ringgit. So the maximum that you will pay used to be 200 ringgit per contract note. This has now been increased to 1,000 ringgit. Okay, and this cap of 1,000 ringgit is until 31st of December 2026. So technically what it means is that after 31st of December 2026, the cap of 1,000 ringgit goes away and the stamp duty will be 0.15% on your contract note amounts. So on the one hand, they have increased the stamp duty. On the other hand, there is now service tax exemption on brokerage services relating to trading of shares listed on Bursa Malaysia. So a little bit of additional taxes, and they have also sort of like countered that with a reduction in service tax. So the next item is in respect of real property gains tax. This is obviously good news for all of us. You will find that over the years, the real property gains tax has actually gone up and down in terms of the rates. There was even 2 periods where it was completely exempted. The change now is effective from 1st of January 2022. Ourselves, people like you and me, we're citizens. If we hold the property for more than 5 years, instead of paying 5% RPGT, it is now 0%. So if you sell any of your property right now, for example, and you've held it for more than 5 years, it will be 0% from this year onwards. Okay. And retention sum, again, for disposals within 3 years, the retention sum, where the disposer is a Malaysian company, there is a need to actually do the retention sum, and it has also increased. Now, I think that will be the end of my presentation so far. The next section is supporting the small and medium enterprises, and I'll pass it on to Stephen to run through some of these measures with you.
Okay, thanks, Jennifer. So I will actually move on to the next topic, which is actually on making businesses resilient, particularly in supporting the MSMEs, right? MSMEs is actually a short form for micro, small, medium enterprises. So if you look at these slides, what government has actually introduced to ensure MSMEs remain resilient against the economic downturns. Firstly, they actually sort of like extend in terms of the 3 years tax rebates of up to 20,000 ringgit for newly established MSMEs for 3 years of assessment, right? So for this to be actually entitled, the MSME needs to sort of like establish an operations between 1st July 2020 to 31st December 2022. And then the next item is actually on the stamp duty exemption for approved M&A, right? So the government actually see this merger and acquisitions effort amongst the SMEs as helping to strengthen the SMEs capacity and also prevent the hollowing out of the companies as a result of the COVID-19 outbreak by enhancing access to funds as well as valuable assets for the new developments. So for this stamp duty exemption, you need to actually make application to MIDEC, the Ministry of Entrepreneurial Development and Cooperative, no later than 30th June 2022. And the instrument executed is actually up to 31st December 2022. So in fact, this was introduced back in 2020, where government announced some measures under Pencana, and these two measures are sort of like 1 year extension that was actually given during budget 2022. So if I actually go to the next slide, where we actually look into more details in terms of the income tax rebates for MSMEs, you will actually note that, in fact, this 20,000 tax rebate needs to be actually equivalent to the CapEx or OpEx amount that was actually incurred by the SMEs, right? And it is actually something that given against the tax payable. In other words, if let's say the company itself does not have any tax payable during the year, in fact, there's nothing that you can actually sort of like offset, and hence this 20,000 rebate is actually not sort of like applicable for that particular year of assessment, and is actually not a refundable or allowed to actually offset against your future tax payable. It's actually given for 3 years. If you look at the bottom right of the slides, you can actually see that if you need to actually fulfill certain conditions in order for you to actually entitle for the tax rebates. Firstly, you need to be a resident and incorporated in Malaysia, and you need to commence operation during this period that what I mentioned earlier. And then because SME refers to those company with paid up ordinary shares capital or contribution less than 2.5 million, and also the other condition is gross business income less than 50 million, right? So say for example, if let's say you actually fulfill the condition in the first year, then you will be entitled for that tax rebate for the year one, right? If let's say you fail to comply with the condition in year two, then what it means is that in year two and also year three, you won't be actually entitled for the tax rebate anymore. So you need to actually assess in terms of your qualification before you actually make a tax rebate in the tax returns of the company. Then if I move on to the next slide, this is actually the third measure that was actually introduced. If you recall, there are various deferment of tax installment that was introduced previously, particularly in terms of the tourism sector. But in budget 2022, they actually announced another deferment of tax installment, especially for MSME, for a period of 6 months until 30th June 2022. If we look at the illustration itself, what it means is that if you are a MSME and you actually submitted your CP204, which is the installment scheme for year of assessment 2022, and the amount is 120,000, right? Under this deferment, because the period is from 1st January 2022 up to June 2022, and the installment scheme that actually fall within that period can be deferred, right? So if you look at the right column, you can see that, in fact, if you qualify for this tax deferment, for the first 5 tax installment, you don't have to actually pay the installment, right? So only when you actually submitted your tax returns, say for example, 7 months after the closing of your accounts, you actually close your submitted your tax returns, and the final tax payable is 90,000, for example, and contrast that to your monthly installment that has been paid of 70,000. So the balance to be paid of 20,000 can only be you can only pay that upon your tax submission. So in that sense, instead of paying 120,000 upfront and waiting for a refund from the RB, you can actually have a saving in terms of your cash flow for the 5 months period. So if I move on to the next slides, there are various of other measures in supporting MSMEs as well. I won't actually go through each of them, but particularly I would just highlight one or two. Like for example, the first one, to sort of like increase the digital adoption amongst the SMEs, the government will actually sort of like increase the SME digitalization grant scheme up to 200 million. Right? And then there are also various financing schemes that government has actually sort of like collaborate with the participated financial institutions to actually give maybe some soft loans or 0% interest financing to those SMEs that actually qualify for various purposes. For example, the Samara Niaga Keluarga Malaysia or Business Recapitalization Fund up to 5 million. So those are some of the measures that was introduced to support the SMEs. If I actually move on to next part, which is actually tax incentive. Tax incentive has been actually used as a tool by the government to attract investment in strategic and also focus area of the economy, right? From experience, it has worked, providing some clarity in government's agenda and also commitment. So in budget 2022, right, a few new and very focused initiatives have been announced. Firstly, is actually the introduction of the DSEC. DSEC in short is actually the Digital Ecosystem Acceleration Scheme. This is actually meant to complement the various initiatives, which can be seen on the left of the screen. to promote the digitalization amongst the Malaysian economies. Some of the example could be the existing MSC incentive, Penjana special tax incentive, which I will go through with you in more detail in the later slides, automation CA, smart automation grant, and etc. Right? This is actually the new incentive to be actually led by MIDA. It's actually hopeful that with the proposed tax incentive, it would actually encourage the digital solutions providers to set up companies, diversify into new segments to support the national digital ecosystem in Malaysia in the next 5 years. So if you look at the special tax incentive under Penjana, which I've actually mentioned earlier in the earlier slides, this was actually introduced during the Penjana announcement in year 2020, and it has been actually extended to 31st December 2022 for a company that interested in this to make an application to MIDA. Right? So there are two categories here. Firstly is actually manufacturing companies, and then the other one is actually on certain selected services sector. Right? This slide is actually focused on manufacturing companies that are relocating into Malaysia. There are two buckets here: new companies and existing companies. New companies is those that, for example, some US company or other companies outside Malaysia that wish to actually set up a manufacturing plant in Malaysia. So if let's say the company invests in Malaysia with the capex of more than 300 million, right? Then you would be able to actually enjoy and entitled for the tax incentive under this special tax incentive. So if let's say the investment amount is between 300 million to 500 million, the government will actually consider a special tax rate of 0% up to 10 years, right? If let's say your investment is actually even bigger, up to 500 million, right? The special tax rate of 0% can up to 15 years. For existing companies, they will actually consider in the situations where you actually is a Malaysia company and you have plant overseas, for example, maybe in Vietnam. But because of the COVID situation and also your business plan, you plan to relocate the plant back into Malaysia, they will actually consider if let's say your capital investment is above 300 million, for you to enjoy ITA of 100%. Right? ITA means investment tax allowance, which is actually depending on the qualifying capex that you actually incurred during the first 5 years. Accumulate that and give as a tax sort of like tax allowance against your tax payable, right? So that is actually for existing company like the Malaysian company like yourself, right? On top of that, if you recall in budget 2021, if let's say the companies are entitled for this incentive, they also actually consider a flat 15% tax rate for key or C-suite position for 5 years, right? So this is actually more for individual perspective. You will be able to actually enjoy a flat rate instead of the gradual rates that is actually up to, if not mistaken, 30%, right? So if I move on to the next slide, this is actually more so in terms of those selected service activities relocating into Malaysia, right? For you to actually, for the company to enjoy this, the company needs to actually adapt the Industrial Revolution 4.0 and digitalization technology, which have a significant multiplier effects. Of course, the significant multiplier effects is actually very subjective. So MIDA has actually released the guidelines to actually say that this can be actually discussed in terms of your conditions, your investment size, for them to actually determine whether you will be eligible for this incentive or not, right? The qualifying services sector includes technology solution services, infrastructure and technology for cloud computing, R&D activities, medical devices, testing, lab and clinical trials, and also any services determined by MOF. From here, you can actually see that those are sectors that was actually promoted by the government, and something that they are actually interested to actually bring into Malaysia to actually increase in terms of the value chain of service sector. So for new companies, depending on the investment size, they will actually consider 0 to 10% tax rate for 10 years. For existing companies that is actually expand into new segments, which is actually fall under the qualifying services sectors, they will actually allow a 10% tax rate for 10 years. Of course, between your existing activities and the new segments, you need to actually have a separate book to keep track, so that to ensure that only the new segments can entitle for the 10% tax rates. Similarly, they allow a 15% flat tax rate for key and C-suite position for 5 years. And also the application needs to be made to MIDA by end of this year. Another extension that is actually given to encourage the expansion, modernization, and also diversification of a company. But this will actually only applicable for those companies that has exhausted their reinvestment allowance for 15 years, right? So there are various extensions being given in the past. For your information, reinvestment allowance is actually given to those companies that involve in qualifying activities, for example, diversification, expansion, automation, and also the other one is actually on modernization, right? So if let's say you involve in those activities, you are entitled for reinvestment allowance for a period of 15 years under normal circumstances, based on the capex that you actually incurred, right? After you exhausted the 15 years, technically there's no more incentive that you can actually enjoy. So to encourage this, the government has actually extended previously once special RA up to 2018 for a period of 3 years. Under the COVID situation now, they have actually further extended. If your company are involved in any expansion, they actually allow another 4 years of, a period of 5 years up to 2024 for you to actually enjoy the reinvestment allowance. Reinvestment allowance, what it means is that if let's say you incur in 100 ringgit of 100,000 ringgit of assets, then 60% of the asset value means 60,000, right? That can be actually set off against 70% or 100% of your statutory income. So in my next slides, it's just some refresh in terms of the condition for RA. I will actually leave it here for you to actually take a look later, which I won't be actually repeated that. But one key thing that I want to actually remind is that for you to entitle for this reinvestment allowance, you need to be in operation for more than 36 months, right? And it's actually applicable to manufacturing and agriculture projects only. Lastly, I think there are other measures as well to keep the business resilient. In my next slides, this is actually continuation of the past measures introduced, where they actually give some sort of extension. As you recall, one of the most common one is actually where if let's say the landlord of the business premises offer a reduction of rental payment, they can actually claim a special tax deduction against their business or rental source income, right? So the special deduction is equivalent to the rental reduction given, which is not less than 30% of the monthly rental. And originally, it was actually given only to SME tenants, but after that, it has been actually also extended for those landlords that give reduction or discount of their rental to non-SME tenants, right? So under the budget 2022, they extend another 6 months up to June 2022 for the landlord to claim the special tax deduction. The other thing is actually on the renovation and refurbishments cost of up to 300,000. This has also been extended. So if let's say you are actually planning to do some renovation or refurbishment, perhaps you can actually consider this by 31st December 2022 in order for you to actually enjoy the tax deduction, because typically those renovation costs of your business premises or refurbishment costs are not entitled for CA or tax deduction for tax purposes. Lastly, the box down there is actually an extension for further tax deduction on expenses for employees' accommodation under Save and Work up to 50,000. This has also been given another 1 year for you to actually enjoy the tax deduction. Okay, so if I actually move on to the next section, is actually on indirect taxes. To me, it's actually exciting times ahead for indirect tax. Not that it has not been for the last many years. So let's see what is actually in store. In fact, one of the key things that was introduced during the budget 2022 is this special voluntary disclosure program, right? And also when subsequently it was actually announced, it includes amnesty program as well to actually waive the penalty that was actually imposed during the audit that was actually conducted by custom, right? So if you look at this, the nature of the indirect taxes is actually quite repetitive, sometimes daily or more often, right? Sometimes the problem won't be known until the tax audit is actually performed, and a lot of guidelines being issued regularly, and there are many gray areas. So you can see that if let's say that happened and you won't know you did not actually realize in terms of the error made, for example, service tax is not imposed for certain services because you thought that it's actually not a taxable services, for example, then in terms of the late payment or even the omission of the service tax is actually quite in terms of the penalty is actually quite high, because it depends on the number of days that you are actually late, and the penalties will be actually increased gradually based on the number of days late, right? And also, if let's say you have incorrect return or failure to submit returns, the fine is actually up to 50,000, which is quite substantial, right? So this is actually a golden opportunity for you to actually reset the compliance to indirect taxes in Malaysia. So let's look at some of the features of this SVDP and also amnesty program. This is actually introduced for a period of 9 months, starting from 1st January 2022 up to 30th September 2022. It's actually split into two phases. Phase 1 is actually for a period of 6 months, and the phase 2 is actually for the remaining 3 months. Of course, during phase 1, in terms of the penalty remission or the potential primary tax remission is actually higher percentage. They can actually consider up to 100% penalty remission. But under phase 2, only 50% penalty remission. And depending on the case-to-case basis, the primary tax remissions could be actually a lower percentage as compared to phase 1. For you to actually entitle for this SVDP program, firstly, of course, you have actually made some error or mistake in your tax returns. You need to actually voluntarily make a compound of 500 ringgit or 1,000 ringgit to entitle for this SVDP. And the types of indirect tax cover quite substantial, covering from GST, sales tax, service tax, import duty, excise duty, and even the export duty. So in the next slides, also based on the guidelines that was actually issued. Next slide, please. Yep. So some of the clarification obtained from the guideline issued is that similar to the direct tax SVDP that was happened previously, the customer has actually committed that this will be actually in good faith. In other words, for those periods that you actually voluntarily disclose in terms of your error of mistakes, there won't be actually further audit to be performed. And in terms of the application procedure and conditions, this will be actually made online via the MyVA system registration. As I mentioned earlier, they also actually includes error discovered during the audit that was actually performed by the custom for you to actually enjoy under this amnesty program. If let's say the bill on demand has been issued on or before 31st August 2022, you will be entitled. Secondly is that if let's say the audit period is on or before 31st October 2021, then you will be actually entitled for this amnesty program as well. And in terms of the rates, it depends on whether there's any tax or duty payable or only the penalty, right? Of course, the rate you can see here, 100% remission in terms of penalty. If let's say there's any tax or duty payable, and phase 2 is 50%. Then if let's say during the audit, after they have actually sort of like audited the company and there's no tax or duty payable to the government and only have the penalty element, then the penalty remission is 90% for phase 1 and 80% for phase 2. So I think it's actually a good opportunity for you to actually participate. If let's say during the course of your checking or whatsoever, you discover that there's any errors that has been made. So in this slide, we just listed out some of the common errors that we actually see amongst our clients. I won't actually go through everything, but mainly to actually highlight to you top 2 from each category, right? The first one, in terms of the sales tax and custom duty, there's a lot of incorrect import pricing or incorrect tariff classification that happen amongst our client. And the second one is misclassification services that has been actually determined as not subject to service tax. So maybe you can consider to actually do a health check to see whether there's any error or mistake that has happened in your prior tax returns so that you can actually participate in this SVDP. So under the indirect tax announcement, you can also see that they are trying to actually announce and also broaden the service tax net in respect of the delivery services with the explosion of e-commerce in recent years. First measure is to actually widen the definition of taxable person. The second one is to expand the taxable services to include any goods delivery, except for F&B and also logistic, right? So please note that this proposal will have a wide implication, not just e-commerce platform, but also if let's say the business is actually involved in selling goods online and then delivers. With these new steps, the cost of delivery will now be actually transparent to customers because the law requires that any value and also service tax of taxable service is to be displayed in on the invoice. So lastly, in terms of indirect tax measures, is actually on the goods imported via air courier through the international airports. Previously, the sales tax exemption is actually applicable if let's say the importation of goods, like for example, if you actually buy any luxury brands outside Malaysia, if let's say the goods below 500 ringgit per consignment, that is actually exempted from sales tax. But moving forward, in order to actually create a level playing field between local and also imported goods, it's actually proposed that sales tax to be imposed regardless of the value. And also both the local and foreign sellers are required to be registered. So this is actually effective from 1st January 2023, which is actually next year, not that soon. So maybe if let's say you are actually someone that actually always buy things online from foreign, then perhaps you can actually do more in this year instead of waiting for the sales tax to be actually imposed in next year. Right. So with that, maybe I will actually pass back to Jennifer to continue with some personal tax measures as well as some of the areas that RB is actually focusing on.
Thank you very much, Stephen. With tax filing season coming up in April, all of us have to file our tax returns next month. Good timing to remind you on some of the personal reliefs that have been extended by the government. So I have about 5 slides here that you may be interested in, and keep handy when you are actually doing your own personal tax return. So there have been extension on some of the personal reliefs to individuals. So if you see up on screen here is the contribution to private retirement scheme and deferred annuity. This incentive has actually been extended to year of assessment 2025 in respect of deferred annuity. So if you have actually contributed to any savings plan offered with guaranteed stream of income for certain years, then obviously you can actually claim a relief. This is up to 3,000 ringgit. And it is a combined limit together with any private retirement scheme that you may have contributed to. Now, the other item which they have enhanced is in respect of contribution to SOCSO, EIS, EPF, and approved pension scheme. If you look over here, they have actually increased the limit of relief to 350 ringgit for SOCSO as well as EIS contributions. As far as EPF contribution is concerned, they have also sort of like cast the net wider to include voluntary contributions, mainly by self-employed persons, including pensionable public sector employees. Now, this is actually effective from year of assessment 2022 onwards. The next item is for advancement of yourself in terms of education. So there's actually quite a few personal reliefs that you can claim if you've taken up additional studies, for example, tertiary studies, master's or doctoral level. So that no change there. The relief that you can still claim is 7,000 ringgit. But what they have done is to actually enhance the limit for upskilling or self-enhancement courses. If you actually enroll in some of these courses, then the relief you can claim is 2,000 ringgit for 2022 as well as for 2023. This has to be conducted by a body recognized by the Department of Skills Development, Ministry of Human Resources. So if you have actually embarked on some of these courses, then obviously you can actually claim 2,000 ringgit in your tax return. Next page. Some of these incentives have been very popular. So what they have done is they have extended it. For example, the domestic tourism expenditure of 1,000 ringgit was actually provided for year of assessment 2021. And this has been extended for another year to year of assessment 2022. So if you've gone for any cuti Malaysia, your hotel accommodation, your entrance fees or domestic tour packages, you can actually claim it in your tax return. Don't forget to keep the receipts. There's also the special relief for purchase of smartphones and personal computers or tablets. This incentive of 2,500 ringgit has also been extended for another year to a year of assessment 2022. And if you have any kids that you send to childcare centers and kindergartens, the relief that you could claim of 3,000 ringgit has been extended for another year for year of assessment 2023. So always don't forget to keep your receipts because they do sort of like ad hoc checks now and then. Last but not least, this is a new relief. So if you're driving any electrical vehicle, then they are providing you with a tax relief of 2,500 ringgit per year on expenses related to EV charging equipment and facilities. This 2,500 ringgit is for 2 years, YA 2022 as well as YA 2023. So good time to consider going out there and buying an electric vehicle, especially with the extension of sales tax as mentioned by Stephen. Now, the next area, I will kick it off by going through the area of focus that we are seeing the tax authorities focus on. I think this is quite interesting to take note of because, as you know, with the pressure to collect more revenue, you will find more and more types of audits and activities that are being conducted by our tax authorities. So what we have seen quite a bit for the last 1 to 2 years is increase in audits and investigations. And they've done it based on industries such as they've focused on property developers and contractors. They've actually targeted the banking and insurance market and industry. Oil and gas is another industry which they would normally go for, as well as retail. This basically is quite wide and they will come in and do the audits of these types of industries. As far as I guess individuals, what we have seen is they've actually targeted high net worth individuals. The Tan Sris and the Datoks of this world, they've actually gone in to do an audit on them. Companies directors is another one, and business owners will be another category where they have targeted as well. So they will run through your capital statements just to see how much you actually own versus the revenue that you've actually declared, to see whether it matches up. And these are actually very, very detailed type of reviews, and they've become very savvy. They are able to get a lot of information. I'm not sure if you're aware, there is this thing called the CRS, where there is sort of like information exchange between governments in the world. They have even gone out to various countries to ask for information that, for example, Malaysians may have, such as properties that you own, or maybe a bank account that you own overseas. So these are the sort of things that they've actually been using as part and parcel of the audit. Tax investigations, there are tax investigations, maybe not as much as previously, but you never know, they could be starting that up soon. So there's always a possibility of raids and surprise visits relating to anti-money laundering laws, aggressive tax planning schemes. There could be seizure of documents and freezing of personal and business accounts. So we don't see as many of that. We see more of the two boxes on the left side, which is the tax audits as well as the individual tax audits. But like I mentioned just now, CRS inquiries, we have actually seen more and more of that, where our tax authorities have actually gone to governments to outside the country, like it could be Australian government, or it could even be Cayman Islands government, asking for information relating to Malaysian residents. If we turn to the next page. So what are some of the other things that they are focusing on? Management fees is something that they will tend to scrutinize. For example, if you have tax losses at the holding company level, and then you could be charging management fees. So they will look at the management fees being charged at the holding company level to see whether it's reasonable or not. And then they will look at the recipient level of that management services to see whether the amount of expenses you've paid and claimed, whether it meets the benefits that you're getting from these management services. So this is something that the tax authorities will tend to focus very much on if you have that sort of intra-company type of charges relating to management fees. They are also beginning to focus very much on value chain as far as the distribution of profits across the key entities within a group, for example, looking at, for example, whether profits are being parked in non-tax paying entities, or maybe in non-tax paying tax havens, like I mentioned, Cayman Islands, for example. So those are the sort of things that they're looking at. And the value chain sometimes may not even be companies within the group. There was a situation that I've come across where payments were being made by one company to another external party that provides the invoicing for tax deduction, and that party then subcontracts it to another 3 companies, for example. So these are the sort of value chain that the tax authorities have also been analyzing, and they have also been asking for bank accounts and bank statements to actually run through the payments made and what has actually gone in and out of the bank account, for example. Financing is another area that they will also look into, for example, whether intercompany loans, for example, whether there's any charging of interest at all for these loans. Sometimes it could be undercharging of interest, or sometimes it could be overcharging of interest. Sometimes there could be corporate guarantees where there are no fees charged. So these are the things that they're focusing on. And especially with earnings stripping rules that have come in, we think that this is another area that they will definitely focus more on when they come and audit you. Now, in part and parcel of their analysis, I think they are also asking for documentation. In many situations, they're asking for documents for them to review agreements, for example. And there is a need to always have all of these handy, because if they were to ask for it and you don't have it, then obviously it will mean that the arrangement may not be as arm's length as what they would like it to be. There have been situations where agreements have been asked for and the agreements have not been properly signed. So that's the other thing also that they've said, that maybe this agreement hasn't been properly executed. So is it even valid or not? So these are some of the things that you need to take note of when you actually sort of like file things away. Next page. So common issues raised by the tax authorities, I will put it up on screen over here. And I guess the slides will also be given to you as well. Very common issues that we've seen, real property gains tax versus income taxes. So many situations, property owners have filed RPGT returns on their disposals, but the tax authorities have come in to say that no, it should be under income tax. So instead of paying, for example, 10% RPGT because you've held the property for a number of years, they could turn around and say, no, it should be under income tax and the tax should be at 24%. Transfer pricing, very common nowadays. They look at transfer pricing of your related party transactions. They ask for documentation and agreements. They have made a lot of adjustments in some cases as far as transfer pricing is concerned. They also look at things like income recognition. Have you recognized the income or have you deferred the income recognition? Deemed interest related to loans, for example, even though you don't charge interest, they have deemed that this loan you should have charged interest, and therefore they have adjusted the amount and said that the company that has provided the loan should have brought some type of interest to tax. Issues to Labuan companies over the past 2-3 years, they have actually been looking at that, auditing the transactions with Labuan and disputing some of the transactions to say that it's not being done on an arm's length basis. And on the right side, deductibility of the cost that you've incurred, to say that actually it's just a provision and you shouldn't have claimed a tax deduction. Looking at incentives that you've claimed to see whether you've met the criteria. And if you haven't, obviously, then they will adjust and not provide you with the incentives, for example. Capital allowances, industrial building allowances, and non-qualifying expenditure is something that they've also scrutinized. In some cases, if you have claimed industrial building allowance, they will actually see whether you've met the condition or not. So I had a client that actually claimed industrial building allowance, and they actually scrutinized floor by floor what are the tenants using it for, and then realized that, hang on, some of the floors, the tenants have not used it as an industrial building, and therefore the property owner does not qualify for those floors, for example. So they actually go down to such details. They will also look to see whether you've done any aggressive tax planning, and they've become very savvy in spotting some of these things. And last but not least, of course, deductibility of certain payments to see whether such payments should be deductible or not. So these are just some of the common issues which you need to take note of. Transfer pricing is an area which, as I mentioned, they actually focus very much on. I think the main point I would like to make here is that now the changes is that you need to make available the documentation within 14 days of requests by the tax authorities, no longer 30 days. So they are basically saying that you should have had it ready and you need to provide it to the tax authorities within 14 days. And otherwise, if you don't, there could be penalties imposed on you. Next page. If you have a loss-making company within the group, as you're aware, group relief can be claimed within the group, where you can transfer losses from one company to another company within the group. Of course, this group relief has somehow been watered down with the new rules. It's become a little bit more difficult to claim. But if you do qualify for it and you claim it, then you need to ensure that the proper calculation has been done. And you need to make sure that the reasons for the losses are genuine, because they will also then scrutinize to see whether the losses that you are transferring is real or not, for example. So those are the main points that we have seen over the past 2-3 years that the tax authorities have focused very much on. So very important for you to ensure that you're prepared because they are focusing very much on audits, especially transfer pricing audits. So I'll turn it back to Stephen, who will share with you some planning ideas that you can consider especially during these times. Over to you,
Over to
Stephen.
you, Stephen.
Thank you, Jennifer. So we will actually move on to the next section or session of our presentation today. So as you know that we are actually under the unprecedented time with the COVID-19 pandemic. Of course, now hopefully we are actually moving towards endemic. But during this period, you can actually see that the economic environment has been sort of like changed substantially. And also all of these above have actually caused a significant impact on the profitability of the businesses as well as put a strain on liquidity. Right. While the suit of the economic stimulus package that was actually announced by the government, which we have gone through earlier, is certainly welcome. But businesses should also sort of like critically evaluate their fundamental robustness to ensure that it continues to be remain relevant moving forward. Right. So you may want to actually relook into the efficiency on how you are doing your business currently. Some of the questions that you may actually ask yourself is that, is your business fundamentals still remain the same? Is your business model still relevant under the new normal? Is my market growing under the new normal, or whether has my customers' need has changed following the pandemic? Especially, you can actually see that a lot of the customer behavior has changed to online shopping, for example, during this period. So lastly, you also need to actually consider, has my business disrupted by the technology? Right? So in answering those questions, you would actually realize that changes would be inevitable. Status quo may not be an option anymore, as organizations should actually explore the strategies to remain robust as well as competitive under the new normal. So businesses should actually therefore consider restructuring itself to conserve and also improve the cash flow in a short terms, as well as enhance profitability and return on capital in the longer run. So we will actually look into the restructuring from two perspectives. One is actually operational restructuring to see what can be actually done from business perspective to enhance in terms of your efficiency. And secondly, we will actually also look at from financial perspective how you can actually restructure to mitigate all those leakage or extra burden in terms of the interest that you actually paid to financial institution or even within the group of companies itself. So I will actually walk through with you some of the possible options for restructuring available for company. These are some of the common options that you can actually consider. I've actually bucketed that into four. What I will do is that I will take some of the example from each of the option here and walk through some of the tax consideration next. Right. So the first option is on how to actually generate the cash through saving from streamlining of the corporate structure, as well as to consider dispose some of the unprofitable businesses. Right. Let's have a scenario. In Malaysia, I think a group of companies generally have overlapping activities, right? They have a lot of interco transaction, intermediate holding companies as also, and it's actually also quite common that cash is being trapped in loss-making companies or companies without retained earning for you to actually flow up the dividend. So business transfer can actually help to streamline the structure to achieve this operational efficiency. Through consolidation, it can be actually streamlined such that it becomes more lean and limber. This primarily entails the restructuring or reusing some of the operating companies, or maybe actually achieved through a consolidation involving companies that carrying on the same business's activity or complementary to one and another. Right? So business consolidation is typically executed via a transfer of asset and liabilities, followed by a liquidation or striking of the transferor. Another consideration is to sort of like looking at your group structure, whether you can actually flatten the structure by removing some of the unnecessary intermediary companies. So to achieve what we actually intend to achieve here is more so in terms of to have an efficient corporate and business structure, and also to actually achieve another item, which is economies of scale. Secondly, we move to the next option, which is actually review of the asset holdings and also your business portfolio. This could be actually done via reclassification of assets or raising fund through an alternative asset ownership, such as like sales and leaseback, or even the asset-backed securitization, what we call ABS. This can be actually helped in terms of raising additional funds. Ultimately, what is actually desired to achieve is that to realize the assets or business value, and to ensure that the assets is actually appropriately used to generate cash flow for the company, right? Thirdly, the third options apply to companies that, if let's say in COVID situation, you do see some opportunities in the current situations where you actually expect expansion or diversification of your business. For example, like healthcare industry, I've actually seen some change in terms of the model of how they're actually doing business. You can actually see that some traditional clinics that have been actually collaborate with some digital company to deliver online consultation services. So this kind of change in terms of the model, as well as venturing into new businesses to achieve the greater market shares, is one of the consideration that you can actually make. Lastly is actually adapting to new normal. I think this term of new normal, we have been actually hearing it for the past 2 years. So a lot of companies will be actually exploring the opportunities, how to adopt or adapt the new normal by changing their business model, using technology or automate some of their processes in order to actually agile as well as to catch up with the market shares. So if I move on to the next slides, I will actually talk more in details what could be some of the tax consideration you need to actually aware of when you actually perform your operational restructuring. So move to next slides. Sorry, can someone move the slides? Sorry. Maybe I will do. Sorry for some technical problem. Okay, can now. Okay, so in these two slides, what I will actually do is that to walk through with you some of the tax consideration when you actually do your operational restructuring, right? So if you look at the first one is business transfer and consolidation. So first thing that is actually comes to your mind that you need to consider is the taxability of the gains arising from your transfer or consolidation, right? The taxability of the gain usually arises from business transfer that is actually not attributable to individual business asset, which usually we call it as goodwill. This should be actually examined carefully. Of course, there are various tax cases that actually held in the manner that the goodwill should not be actually taxable for a company if, let's say, this is actually as a result of destruction of a company profits making apparatus. On the basis this is actually capital in nature, but on top of that, you should also analyze line by line in terms of your assets or liability transfer back, because there could be some implications that you need to actually take care of, right? Then the second thing is actually is also important for you to actually analyze which company has unabsorbed losses and capital allowance, as this will actually give you a guidance as to how you should actually restructure your company, whether there's any possibility that those company with unabsorbed losses or CA can help to shelter the profits generated from the transferor entities moving forward. Of course, this can be actually used as a guidance, but to note that what Jennifer has mentioned earlier, the tax losses have a 10-year limitation. If let's say there's no expectation of profits in the next 10 years, potentially this will be actually a permanent loss to the company, right? So the third point is actually on the financing cost. From funding perspective, you need to actually consider how you should actually fund the acquisition, and also it's actually important to make sure that proper documentation is kept to ensure and also support the usage of the fund for your claims or interest expenses. Lastly, the managing tax transaction cost or opportunity for relief. As part of the transfer, one thing that you need to actually consider is the cost for stamp duty. And also, if let's say you transfer any property, whether there's any RPGT that you actually need to actually factor in when you actually do your benefit test, benefit analysis, right? Benefit cost analysis. And if let's say the transfer is actually eligible for any stamp duty relief or RPGT relief, perhaps it's actually worthwhile for you to consider that to see whether you meet the conditions and is able to actually apply for the relief, right? So with that, of course, business transfer and consolidation is actually one of the key things for restructuring, but I would like to actually emphasize as well as all the restructuring should be actually for commercial reason and not tax driven. Otherwise, it would be actually sort of like challenged by the RB. And also, as you hear previously in the earlier slides, that some of the key focus area of RB is actually to look at transfer pricing and also TP documentation. So this you need to actually ensure that all the transactions are bona fide and is able to actually support it from your supporting documents. The next thing is actually on asset reclassification. Sometimes company would wonder what they can actually do with their unsold inventories and stocks. For example, in the case of property developer, if let's say they have unsold inventories, whether they can actually keep it for their own use or they can actually use it to lease to third party, right? So at this time, a lot of company would have actually do such asset reclassification, but there's one thing to take note is that if let's say you actually have changed in intention in terms of your asset reclassification, you need to actually consider whether any deemed sales provision in the Income Tax Act or RPGT Act, because even you change the intention, you have not realized in terms of the gain or profit out of your unsold stocks, they will actually impose and deem you actually have already sold the stock, and with income tax or RPGT provision will be actually applicable, right? Then, of course, after you have changed the intention for own use, whether that will be actually eligible for capital allowance claim lah. So third, if I move on to the next slide, in a situation where the company venturing into new businesses, by way of expansion or diversification, you can actually consider whether any available tax incentive, which I've gone through some in my previous slides, and whether you should use existing or new company to actually sort of like perform your new activities. Of course, as highlighted, one of the consideration is to see whether existingly you have any company with unabsorbed tax losses or CA for you to actually able to use that company to house the new activities. The other thing also important, because you need to actually determine in terms of the source of income, whether is that similar to what is being undertaken by your existing company, because that will actually have impact from tax perspective to see whether you can claim CA or not for that particular businesses. Financing costs, not to emphasize again, supporting document to ensure that you have supporting to show that the fund that is actually being borrowed is actually used for your businesses and not for other purposes. Otherwise, it will be actually restricted. Lastly, adapting to new normal. I think the focus more is actually on digitalization and also automation of your processes to see whether there's any incentive available, and also in terms of the software purchase, what will be the treatment, can you qualify for CA and etc. Especially if you actually made payments to non-resident, you need to actually take care of your withholding tax compliance as well to see whether there's withholding requirement or not, right? Also, from tax perspective, imported services and digital service tax needs to be actually taken care. So my next slide is just to actually give you some overview in terms of what would be the existing incentive or grants that is actually announced by the government to facilitate the digitalization. I won't go through because some we have actually mentioned in our earlier slide. For example, double deductions will be given to employers that implement flexible work arrangement or capital allowance for computer software, etc. So with that, I've actually looked at operational restructuring, but from cash perspective and also from financing perspective, how can you actually manage your cash flow from tax perspective and also business perspective? A simple way is actually looking at how to manage your tax cash flow. This can be done by way of looking at your estimates of tax payable every year, because as you know, every company you need to actually estimate upfront in terms of your tax payable and make monthly installment to the government or IRB, right? And you have opportunity to actually make a revision in your 6 or 9 month, and even now they actually allow you to revise in 11 months. How we can actually make use of that to actually save the cash flow for the company, right? I will show you 2 examples later, but before that, some other things you can actually do, perhaps some simple steps could be after you file your tax returns, immediately go and actually apply for set off against your next year installment scheme or to expedite the tax refunds. And also, if let's say you do really have some error mistakes made in your indirect tax returns, to participate in SVDP for indirect tax as well. So in my next slides, I will just show you a simple example of how you can actually save your cash flow from making a revision in terms of your tax estimates. So say, for example, you actually submitted your tax estimate of 120 ringgit, 120,000 ringgit for YA 2022. Right? Because you actually have an opportunity to revise downward or upward in terms of your monthly installment in 6 and 9 months, perhaps you can actually reduce your tax estimate in the 6 month up to the payment that you have made so far. In this situation, 50,000, so that you can actually save in terms of cash flow of paying the monthly installment from July and September. But because you actually need to estimate, I would say, accurately in terms of the buffer between your estimate and also your final tax returns, you may need to actually revise upward again your monthly installment in the 9 month. Then you can actually do that in your 9 month instead. Then from here, you can actually see that even though you will actually paying the same amount from your original estimates of 120,000, but from July to September on this period, you can actually save your cash flow of 30,000 from paying the installment and use that for your business purposes, right? To generate, maybe even if you put in FD, then you can actually generate interest. So there will be a cash saving here, right? So in my next slide, because government introduced 11-month revision, you can actually also do that and revise upward only in 11 months, right? So this is actually have a cash saving of 5 months instead. So if I move on further, is actually on how you can actually manage your business cash flow in terms of looking at cash costs. For example, if let's say you want to actually raise additional funds for your business, or even when you actually consider some financial restructuring, how you can do that and what should be actually considered. And thirdly, you can also review your existing payment obligations to see how you can actually enhance that, right? So if we move on to the cash flow, cash cost, of course, this is actually about when the company require funding for its business, right? In what mode that you can actually consider to increase in terms of your funding. Firstly, is actually equity. Equity is like your dividends or issuing of RPS, for example. Then secondly, you can actually also consider whether it will be actually worthwhile for you to consider internal or external borrowing, or even the hybrid model, which is the third one. which by way of instrument which have a mixture of characteristic, right? So just to take note, if let's say you are actually issuing shares to raise your fund, dividend is actually not taxable, not deductible. And also, if let's say you are actually a property rich company which have land, which have a lot of land-based property, then perhaps one thing that you need to take note is that potentially your shares could be actually tinted as what we call real property company share, RPC shares. So you need to actually plan it well so that you can actually mitigate that. Otherwise, upon your future exit or future disposal of your shares, then potentially RPGT may be actually applicable. Then in terms of debt raising, then you need to consider in terms of your interest deduction, whether it's actually deductible from the company perspective. And also, especially if let's say it's internal, intra-group, intercompany lending, then you need to ensure that transfer pricing is actually considered in terms of charging the right amount of interest. As what Jennifer also mentioned, ESR, earnings stripping rules, if let's say you have intercompany loans from overseas. And lastly, the withholding tax, you need to actually factor in as a cost to the company, especially if this is a related party transaction. Hybrid model, you need to really look at the characteristic of the instrument to see whether that is actually considered as equity or debt from tax perspective. If let's say it's actually considered as equity, then any interest payment that you actually made from, for example, your RPS, that could be actually seen as a dividend and not taxable. So next item is actually to consider your financial restructuring. Firstly, when we're actually talking about financing, we have external financing as well as internal financing. So when you actually do your debt restructuring, one thing to take note is that from borrower perspective, interest is only deductible when it's actually due to be paid. And taxability should be also the same timing if let's say this is intra-group lending, right? So if let's say you do have that, or even when you look at any interest fee loan that is given currently, whether you have supporting document to justify and also to support in terms of your loan being given. Otherwise, perhaps IRB may actually deem interest at the lender perspective, right? Then lastly, what is actually being introduced last time is also when you actually go through these loan restructuring or rescheduling agreements, they actually give some sort of stamp duty exemption up to 31st December 2022, right? The second and third box is actually debt capitalization or debt waiver. You may actually think that sometimes it looks the same, but in fact, in substance, is totally different in terms of the tax treatment as well as how you record from your books. Debt capitalization essentially is you capitalize your existing debt into equity, especially if let's say in a situation you actually lend it to a company that is actually in a loss situation, right? Then from the loss-making company, you can't claim a deduction on your interest expense. But from the lender perspective, you need to subject the income interest income to tax, right? So from group perspective, that may not be that efficient. So some companies consider the debt capitalization as one of the option, right? But when you actually do that, you need to be very careful in terms of the tax treatment of the capitalization. Firstly, whether the interest is actually deductible when you actually capitalize. You need to actually have robust documentation to actually prove that. And also in a situation, if let's say you make a payment to you capitalize the amount is actually from a foreign company perspective, because when you do the capitalization, technically the interest is considered as being credited already for the use of the lender. So then withholding tax could be actually applied in that case. Debt waiver is actually a forgiveness of debt. Um, there are a lot of case law that actually happens to actually determine in terms of whether debt waiver from the borrower perspective, whether that will be actually subject to tax. But what you need to actually be very careful is that when you do a debt waiver, from borrower perspective, you will recognize again, right? Then in terms of the taxability of the debt forgiveness, you need to actually analyze in terms of the usage before you determine whether it's taxable or not. More likely than not, IRB will like to actually challenge that is taxable, but it's depending on the usage as well as your documentation to support whether you can actually argue that this is actually in fact a capital gain for you as a company. From lender perspective, you need to assess in terms of the deductibility of the bad debt expenses. I would say that if let's say the lender is actually not in the business of lending money, it will not be actually sort of like deductible most of the time. The next slide is just to actually give you a flavor of how usually the debt capitalization and debt waiver can be differentiated. Debt capitalization, of course, ultimately both scenario you will offset in terms of the amount owing, right? But in terms of book recording as well as the substance of it, debt capitalization will have additional steps because for you to offset the amount owing, the subsidiary will need to actually issue additional shares or RPS to the parent co. And from parent's company perspective, this is actually an investment in the subsidiary. Contrast that to debt waiver, parent co will actually just write off the amount owing, but the subsidiary will recognize as a gain in the books. So from tax perspective, it's totally different. So you need to actually be aware of when you actually do your set off or amount owing, because a lot of people actually think that this is actually no difference, but from realistic perspective, it's actually totally different. Lastly, we can actually look at the payment obligation, what you can actually do. Sorry, before that, I will actually just give you some examples of financing options that you can actually also consider. Firstly, is debt push down, whether the existing loan from your holding company can be actually pushed down to the operating company in order for you to maximize in terms of your interest expense, right? And also, secondly, it will help you to minimize the intercompany transaction, right? In terms of financing, you can consider either ABS securities or Sukuk for you to raise fund, right? Why this is actually, I draw out these two is because under the ABS securitization transaction, there are various exemption that is actually being given. Say, for example, if let's say the asset-backed securitization is involving the property, then any transfer of the property is exempted from RPGT. And on top of that, the company can also unlock the value of the property to actually obtain fundings, because technically when you transfer out your property, you need to actually sell at a market value, right? Stamp duty exemption also very available for the ABS securities. Then from Sukuk is actually another attractive financing option as well, because government has actually promoting this and introduced various deduction or stamp duty exemptions to issuance of Sukuk. Like for example, if let's say you are issuing Sukuk Wakala, then you will be able to enjoy certain deduction of your cost of issuance, because generally those cost of issuance is not taxable, not tax deductible. And also stamp duty exemptions available if let's say you issue those Sukuk to the public. So lastly, we actually look at by reviewing your payment obligation, some of the options that can be considered. Firstly, you will definitely sometimes you will negotiate in terms of your deferment of suppliers' payment terms. Then you need to actually consider by deferring that whether you can actually entitle for tax deduction of those expenses, or this will be actually just being a provision in your books and you won't be actually entitled for the deduction, right? Then secondly, if let's say you request for the discount or rebates, then technically that rebate is actually sort of like will reduce in terms of your expenses, and hence the deduction is only on the net expenses that you actually paid to your vendor, right? Thirdly, you may also consider restructure your HP obligations. because the tax treatment for HP assets like vehicles is actually based on the capital payment that you actually made so far. So you need to actually make sure that your CA claim in the tax computation is in order when you actually restructure your HP obligation, right? With that, I think these are some of the ideas that we want to actually share with you today in terms of what you can do and we look into your businesses to improve your efficiency. Of course, again, I would always emphasize that you need to actually ensure that your documentation is in place and the restructuring is not tax driven. Otherwise, tax authorities may always challenge that under the anti-avoidance rules that they will actually look through your structure and see what is actually the tax benefits that you have actually achieved out there. And if let's say you can't support with your commercial reasons, they will always sort of like do the adjustment accordingly. Yeah, so as a summary, I think I will pass back to Jennifer to go through with you some of the key takeaways today.
Thank you very much, Stephen. I just have one slide for some of the key takeaways. So some areas for you to take note of would be, some of the benefits that have been announced in the budget. So obviously the efficient utilization of tax losses in view of the limited application of group relief, as well as the 10-year time limit for ability to carry forward losses. So some of those areas would be something that you need to consider. Opportunities for relief on transactional tax costs such as RPGT, stamp duty, indirect taxes that Stephen talked about, the special voluntary scheme, for example. And one of the things that you can really look at is in terms of your group structure and the efficient deductibility of financing costs. You will find that in a lot of group structures, that's something that you will need to focus on to get tax efficiency. And having a review of your financing and the cost of that is something that you should do for tax purposes. Of course, you can actually get into restructuring for tax efficiency as well in your group structure, but important that there are bona fide commercial considerations as well driving this restructuring. So something that you will need to look into to actually do a bit of tax planning. Related party transactions is something that you will need to also focus on. There could be tax savings there, but also you will need to ensure that because it's related party, transactions needs to be done on an arm's length basis because the tax authorities will focus on that for transfer pricing reasons. And last but not least, of course, documentation is very, very important these days because in the audits that the tax authorities have come in for, they have normally asked for agreements as well as documentation. So important that whatever you're doing to your structure as well as your financing, you will need to ensure that all of these are documented well and that copies of such documentations are kept on file. So with that, we end our presentation this morning. Thank you very much for your time. And I guess we will open it up to any questions that you may have, and we can actually address those questions.
Thank you, Ms. Jennifer and Mr. Stephen, for the valuable sharing. We will now proceed with the Q&A session. If you have any questions, please scan the QR code projected at the screen, or you can type at the MS Teams Q&A chat box. So we have our first question for the speakers. For individuals, what happens after 5 years? If the funds are brought back, will this be taxable?
Okay, so yes. So the answer, a very short answer would be yes, because the announcement is only for 5 years. So during these 5 years, if you were to bring the foreign source income back to Malaysia as individuals, you will not be taxed. But after that 5 years, obviously, if they do not extend this incentive, then it will mean that you'll be subjected to tax. But always remember, the tax is on income. So you will need to ensure that you have proper documentation to determine what you're bringing back, is that income or not? Because remember, we do not have capital gains tax here in Malaysia. So for example, if you have investments overseas and you've actually sold those investments, and let's say you have kept it, the money overseas for reinvestment, and after 5 years you decide to bring it back, technically, if what you're bringing back represents capital gains, it should not be taxable. But the question is, are you able to prove that what you're bringing back represents capital gains, or is it income? So again, documentation is very important. You will probably need to track the payments and what you're actually bringing back. So the income tax will be on income only. So for example, interest income on fixed deposits that you've paid overseas, then yes, if you bring it back after 5 years, it'll be taxable.
All right, thank you, Jennifer. How active is the RIB in tax audits on taxpayers? Is there any specific criteria that the IRB is looking at when they select the taxpayer to audit?
A good question there. I will start and maybe I'll see if Stephen have any other comments. I guess if you have a look at the earlier presentation where we actually listed down some of those popular industries that the tax authorities tend to focus on, you know, these will be things like industries like property developers, banks, insurance companies, oil and gas companies. So those types of industries, the tax authorities tend to focus very much on, and you find that year in, year out, they will do audits on companies in those industries. Now, sometimes the tax authorities may focus on some industries, which, you know, they will take a turn. Sometimes, you know, once in a while, they will say, okay, we will focus on the fund management industry. So for that 1 year, they will focus on the fund management industry, and they may actually audit the fund managers and funds. And then another year, they will look and see, okay, maybe this is an area which we have not focused on, special purpose vehicles, then we will focus on that. So there's actually no set sort of like guideline. It actually varies from time to time, and it will tend to be industries where they have not done any audits, or you could be just a generic trading company, and you know, they will then see, okay, what is your, for example, some of the things that you've claimed. If they find that you are in losses year after year, you could be a company that they will come and audit you, for example. Or if your level of income exceeds a certain level, or you may be claiming incentives, then yes, they will come and audit you, for example. Or if you're claiming refunds, tax refunds, then potentially you're also one of the targets to be audited. So apart from the general industries I mentioned about, which is like banks, insurance companies, then the other industries will tend to be ad hoc, year by year. They will then decide, and also situations where, for example, if you're claiming incentives or you have tax refunds, then they will come and audit you.
Maybe I would just add on. I think, of course, during the presentation, we also actually emphasized a lot on transfer pricing. I think nowadays, RB is actually getting more and more savvy in terms of looking at the related party transaction. And you can see that even though when the audit letter being issued to the taxpayer is actually not really focused on transfer pricing, but when they actually look at your tax computation, your audited accounts, they will actually ask a lot of questions in terms of your related party transactions, right? So you need to really ensure that your related party transaction is actually on arm's length basis and is able to actually support it, especially from documentation perspective. Because a lot of times you will see that taxpayer tends to actually lack in terms of documentation, especially when it comes to transfer pricing. So this is actually something, some area that you need to actually really take care of as well.
That there's another related question pertaining to that. This one is, what are the areas that IRB tends to focus on when it comes to restructuring, acquisitions, and disposal?
maybe I will, I'll take that. I think when it comes to restructuring or acquisition or disposal, one thing is actually, of course, in terms of the taxability of the gains arising from the disposal, right? Whether that will be actually seen as income or is actually capital income, right? If let's say it's capital, then it's actually not taxable. Then the other thing is that when you actually have any gain out of your disposal, especially when you involve any transfer of property, then another point that Jennifer has highlighted with previously was whether that disposal itself should be subject to income tax or RPGT. So I would just maybe take a scenario here. If let's say you are actually a property company, right? And you have been actually holding the property for a period of times, then when you actually dispose of the property, for example, it's actually a mall, then typically, if let's say you have sufficient documentation to actually prove that your original intention of holding that property is for your long-term investment to generate your lease rental income, then potentially that can be actually seen as a capital disposal, which will be actually subject to RPGT with a lower tax rate if let's say you hold more than 5 years. Otherwise, if let's say you don't have any documentation or proof, or somehow from your board papers or board minutes that they actually found out that you in between you actually do have some intention to actually sell the property for profits, or you actually have some people that actually going out to actually see whether any opportunity outside the market to actually sell the property at a profits, then potentially they will actually say that this is actually income tax and subject to the 24%, which is actually at a higher rate lah. So this is actually one of the key area that they will actually focus on. Then of course, I also mentioned that potentially any disposal of your asset and liabilities, there will be actually some stamp duty exemption or RPGT relief that you can actually obtain. So as part of the audit, sometimes they will actually look at whether you really comply with the condition to enjoy the relief or not. Otherwise, they will actually just revoke that and claw back whatever taxes that you actually need to pay from out of the transaction. Yeah. So maybe
I guess the other thing is also substance. One of the areas that tax authorities will tend to look at is substance. So, for example, we have come across situations where companies could be charging fees. As part of your restructuring, you may actually want to say one of the company may actually be charging fees to related parties and all that. They will also want to see, do you have substance to be charging those fees? So for example, if your company only has 2 or 3 people and yet you're charging these huge fees, they will also start to look at can those 3 people support the transactions that you are charging for? So they'll go down to that level to see how many people you have got in the company. Are you able to support the fees that you are charging, for example, or the transactions that you're doing?
All right. Thank you, Jennifer and Stephen, on that. Another one, can you share some risk areas commonly overlooked in an internal restructuring?
Maybe I will just give some of the example. I think commonly people will actually think that transfer of business is actually capital in nature, right? And that will not be actually subject to tax, right? So that is actually one area that is actually always overlooked. Of course, a lot of time it can be actually argued as capital, but I've also actually have a case, I think in the last 1 or 2 years, where IB actually challenged whether you really have documentation to prove that your disposal is actually really lock, stock, and barrel, and with that you actually seize company, and hence it should be argued as capital in nature. They are trying to actually see any avenue to actually subject the goodwill or the gains from the disposal to tax, right? The other thing is that sometimes if let's say you move some balance sheet items, for example, properties or even debts over to another company, then you may not actually realize that you need to actually make certain tax adjustment to actually make it right in terms of what should be the tax treatment for the respective items.
I think another area also is forgiveness of debt. Yeah, you may have intercompany loans or intercompany debts in the group, and there have been many situations where clients will say, "Oh, I just want to write off the debt," or "I want to just forgive the debt," and they don't realize that there's actually tax impact there. When you forgive the debt, the tax authorities will tend to say that the company that actually has the benefit of the debt being forgiven should actually bring that benefit to tax. So that's another area that they will focus on as well. I guess the other thing which you will take note on is a debt versus equity type of discussion. Depending on how you finance your subsidiaries, whether you're financing it through a loan or is it through some quasi debt type of instruments, that is also something that the tax authority are starting to focus on, especially if you have very, very long-term loans or long-term amounts owing. They are also coming in to see, is that really debt or is it more equity in nature, for example? So those are the areas which you will also need to focus a little bit on if you have any of those items.
Next, we have for personal receipts. 1,000 purchase for smartphone, tablet has been extended to 1 year until 2022. Does this mean we can claim 1,000 in 2021 and another 1,000 in 2022, or 1,000 in both 2021 and 2022?
It should be in each year.
All right. Okay. Thank you on that. Next, we have another question. Certain foreign income will be exempted for the period of 5 years until 31st December 2026. Will this also apply to unit trusts? Will the foreign income be exempted for the period of 5 years, or will it be taxable?
So very good question there, because I guess a lot of people actually make investments into unit trusts. Now, the unfortunate thing is when the government actually made that announcement December 2021 last year, there was no mention about unit trust funds. Yeah, they talk about companies and limited partnerships, but the word unit trust was somehow not part of their announcement. So we will have to wait for the guidelines to see whether unit trusts will be included or not. But if you just follow from that announcement that was made in December last year, it appears as if unit trust is not included in that 5-year exemption. Yeah, but I guess this is something that we have given feedback to the authorities, including the Securities Commission. And hopefully when they draft the guidelines, hopefully they will include unit trust funds. But purely just on what they have announced, it doesn't appear that unit trust funds are included.
Okay, thank you, Jennifer, on that. Next, refer to the 2% of withholding tax. Shall the employer have to pay 2% for those agents or dealers with less than 100K payment threshold in immediately preceding basis years?
So I will take this question. So basically, as you actually can see from the words withholding tax, right, is actually a withholding tax, withholding mechanism that is actually being introduced. So for this 2% withholding tax, how it's actually being determined is that it will actually look at the individual agents and distributor in terms of their monetary and non-monetary payments that being made by the company in the preceding year. So say, for example, in year 2021, the company actually make payments inclusive of both monetary and non-monetary more than 100,000 to the individual, then in that case, the company, when it makes monetary payments to the individual agents in YA 2022, you need to actually withhold a 2% withholding tax when you actually make the payment to the individual agents. So in other words, say for example, if let's say in January 2022, you need to actually make a payment of 10,000 to the agents, right? So because that in the preceding year that already met the threshold, what it means that the company, when it remit the 10,000 to the individual agents, they need to actually deduct out the 2% to the when they make payments to the agents and remit that to the IRB, right? Then what the individual agents receive in net is only the 98% of the 10,000, right? But that is actually not a final tax. So when in next year the agents actually receive the form 58 CB 58 from the company, they need to actually report the gross amount that they actually receive from the company and submit their tax returns, and the 2% withholding tax they can claim back as a tax credit when they actually submit their tax returns. So it's actually an advanced tax being collected by the tax authorities lah, in other words.
All right, noted on that. We have one last question. My company has made investment in a retail money market fund and received distribution from the investment. How can my company claim back the tax credit of 24% withholding tax?
So normally when the fund managers distribute, make payments on behalf of the unit trust funds to investors, they will actually provide you with a distribution voucher. And in that distribution voucher, there will be information in terms of what types of income that is being distributed to you, whether tax has been deducted. So that information of the distribution voucher, no different from a dividend voucher, except that it has more information. And when you file your tax return, obviously you will need this distribution voucher to know what is being distributed to you so that you can actually bring in that amount into your own tax return. Now, the distribution voucher will then also show you what withholding tax has been deducted. So when you file your tax return, you would have declared that distribution in your tax return, but you can then take the withholding tax in your distribution voucher and set it off against your final tax payable in your tax return.
All right.
Yes, no different from, if you remember those days where dividends were taxed and there was a section 110 tax relief that you can claim as a tax credit. So it's very similar mechanism like in the olden days. Any more questions?
All right, I think that will be our last question. Due to time constraint, for any other question, please put it in Slido together with your email address. Our team will get the details and get in touch with the sender accordingly. Ladies and gentlemen, we have come to the end of our session for today. Thank you for the valuable sharing from Ms. Jennifer and also Mr. Stephen. For your kind information, we have shared a survey link in the chat box, and we would appreciate if you could spend a few minutes to complete the survey. Once again, we would like to express a big thank you to our speakers from PwC Malaysia for this sharing session. We also wish to thank all our guests for joining today's event. Till then, stay safe and have a pleasant day ahead. Thank you.
Thank you, everyone.
Thank you, everyone.